there, you're watching Investors Guide and ET Now. Thank you so much for joining us this weekend. Like you do every week, we appreciate your support. Now, the show has been helping you with your finances and your portfolios for the last 5 years, and we continue to do so. Write to us, email ID is at the bottom of your screen. Send in any question at all that you have about your money. It'll be our pleasure to hear from you. And you can reach me personally on Twitter. Let's get straight to it. Over the next half hour, we'll begin by helping a woman investor sort out her finances, and we'll help her get on track. In our product review this week, we look at the Reliance Growth Fund, and we'll also tell you where you should invest your money to save tax if you're retired. All right, it's time for me to bring in Narendra Kumar, the CEO of Value Research and our in-house mutual fund expert. Narendra, thank you so much for joining us.
Thank you.
Let's get straight to our first question, which is our portfolio question. 30-year-old Sonika has written in from Gurgaon, Narendra. She has two lovely children who are 5 and 1 year old, and her husband is the only earning member. Now, the interesting part about this family is that she wrote in saying she's been watching this show for the last 4 years, and both she and her husband have designed their entire portfolio based on advice that they've heard on the show, which is why, Sonika, when we looked at your portfolio, we were so pleased because you seem so completely in control of everything, and you sent us such a beautifully organized portfolio. Narendra, to take you closer through it, the family has a post-tax income of about 30 lakh rupees. They save about 1.8 lakh rupees every month. The good news is, let's ask about the emergency fund, 50 lakh rupees in their savings bank account. The breadwinner, who is her husband, he has a term cover of nearly 2 crore rupees. He has a critical illness cover. The whole family has health insurance. That is such good news. Now, apart from this, 22 lakh rupees in the Employee Provident Fund, 3 pieces of property across the country worth close to 2 crore rupees, all of which are completely loan-free, an inheritance that they're looking forward to worth 50 lakh rupees, which will come to them in the next couple of months. The only thing that we should slightly worry about, insurance policies that they have. These are ULIP investment policies, and they're putting about 14,000 rupees in those policies. I'm not sure if they're necessary. And of course, they have 54 lakh rupees in mutual funds. Now, before we get into the mutual funds in particular, I think we must admire this portfolio. It's so beautifully in control and organized. Their main question, Narendra, is the added 50 lakh rupees plus the inheritance is about 95 lakh rupees that are going to come to them, which is in cash. How would you like them to deploy this money towards the goals of their children's future, education, and their own retirement? What would they like them to do with that cash?
No, before that, I'm very pleased with the way the whole money is spread and the whole thing, all their accumulation and all their asset is, accounted for here. And it's quite a happy situation. Before that, deployment plan, I think it's important to understand that, how their current financial investments, how do they look like? And in that framework, looking at the thing holistically, one is that she just needs to drop some of the investment she has been making, because if you look at the EPF contribution, that takes care, that fully covers the ATC, and if you add the term cover, it will be more than the ATC entitlement. So that is taken care of. So my suggestion will be that she should have 10 lakh rupee worth of emergency fund in a deposit, maybe a little bit in cash, and rest of it should be deployed in an all equity portfolio, or maybe a reasonably all equity portfolio, maybe 80% equity, 20% fixed income, dynamically managed. And for that, it is important that their existing equity portfolio, or the money which is getting into equity funds and their accumulation, that they need to drop some funds, which is primarily the gold fund, the debt funds. And once that is taken care of, all this, the 80-90 lakh rupee which has to be invested should be spread in those investment itself. This is a good portfolio. This is a beautiful portfolio. All funds have credible history. Both the accounts, her and her husband, are spread in a manner which provides her reasonable diversification across various style, and it is not into any of the exotic funds. So those exotic funds and the Access Triple Advantage, the short-term debt fund, she can do without those funds, because that is more than adequately taken care of by the Employee Provident Fund accumulation so far.
So that's the advice you're getting. Just your equity funds, which are your Birla Sun Life Frontline Equity, IDFC Premier Equity, Reliance Equity Opportunities, Access Equity. These are excellent funds. You can continue with this portfolio and, of course, divide all of the fresh money that you're getting across this portfolio as well. Narendra, she has one very interesting question for you. She wants to know, does it make sense for them now to take an exposure to the international market through an international fund? And this is advice that you give us on a regular basis. Now, looking at their portfolio, I'm going to guess that you will say get an international fund, but can you give them a cap or a value that they should be investing in that fund at this point?
I think India remains the fastest growing market, or the one with the potential, particularly at this point when the optimism has come in. But that apart, she should, a portfolio should be reasonably diversified, and more so from the standpoint of gaining a diversification where a part of the money gets into an asset which will be adequately able to take care of the educational need. If you have young children and 15 years down the line, if they go for their education and that destination happens to be the US, it will be good to have that exposure. That apart, the quality of companies or the portfolio or the investment, it will be into a globally competitive businesses, and that I think presents a very compelling opportunity. If we are sure about these two things and on a long-term basis, but that is not going. It'll happen with its own ups and downs. So build your position into this, maybe up to all your accumulation 10 to 15% over a period of 8 to 10 years.
All right, Narendra, one very quick question. Gold jewelry worth 15 lakh rupees. Sonika, I would advise you to not consider that an investment at all. If that's jewelry that you like and you own, then that's an expense. So remove that from your investment portfolio. She has 3 insurance policies, Narendra. There's one child plan from Aviva, one money back policy from LIC, and an endowment plan from Tata AIG. Now, considering they have enough term insurance and they have a great portfolio going, would you like them to examine the need for these plans and decide whether or not they want to continue with them?
No, I don't think there is a need to examine this, because once you are approaching things so directly and you are accumulating your savings and you are debt free, this is just a legacy, so it just amounts to all you need to do is have a planned exit. Take out your policy document, find out how the best way. It may not be wise to try and find an exit opportunity tomorrow morning, but try and find out how you can get out of these investments with least penalty.
All right, Sonika, it's been such a pleasure to look at your portfolio. It always makes us glad to hear from someone who's been watching the show on a regular basis and who has benefited from the show. For the rest of you who are watching, this is what happens if you follow our advice. Your portfolio looks good and your savings look solid. Good luck to all of you who are investing. Let's take another question. Anand has written in, 27 years old, a take-home salary of 50,000 rupees. He saves 1 lakh rupees every year in his Provident Fund account and invests 2,500 rupees in HDFC Top 200, IDFC Premier Equity and Reliance Equity Opportunities every month. Narendra, he's not married, but he wants to begin saving for his children's education and future. Now, there's a young man with a lot of foresight. He wants to know if he should increase his investment by 50,000 rupees in his PPF, and if right now his mutual fund investments are on track, what would you recommend he does?
PPF is good. But I don't think it's a wise thing when you have time on your side. So maybe, he should reduce his PPF investment and he should just make the mandatory essential annual investment a deposit in his PPF account so that he is able to, keep that account live. He should also take into account his EPF contribution. If he's in an organized job, there will be a EPF account, and his Provident Fund account will entail him the tax credit. So he should add it up, and all his remaining entitlement should get into ELSS. That apart, he has chosen good funds. He should invest as much as possible, and so that's my suggestion to him. Reduce his allocation to PPF and move into ELSS.
All right, Anand, so that's the advice you're getting right now. You don't need to be adding more money to your PPF, and if you have already a deduction of PF going out of your salary, you don't need the PPF at all. So look at your portfolio one more time and decide what you want. And if you're looking at something that's 15, 20, 30 years away, and you're planning for children when you are not even married, it means that you can invest in equity because you have such a long-term horizon. Get back in touch with us if there's anything in that advice that you did not understand. One last question before we go into break. Manoj has written in. He wants to create a corpus of 1 crore rupees for his own retirement with a time horizon of 10 years. He can put aside 50,000 rupees a month, and he wants to know how he should invest this money over the next 10 years. So he has 10 years, Narendra. While it's not a very long term, and we would have liked him to start about 10 years ago, with the 10 years that he has in hand right now, where would you like him to invest that money?
No, but at the same time, 10 years time, 50,000 rupees a month investment, I don't think it is an unrealistic expectation, because his own contribution will be about 60 lakh rupees of this 1 crore, which he is looking forward to, in 10 years time. So that is a fairly easily achievable plan. I would suggest him that, he look at our stable growth portfolio, be methodical about it, be very diligent about it, keep doing it every month, and maybe, not invest in the 4 funds, maybe just choose 2 of the 4 funds.
On our screen right now is our stable growth portfolio that you can write down and you can use for that goal. And if you have any more questions, of course, you can get back in touch with us. Make sure you have health insurance, though, as you're approaching retirement. It's time for our product review, and this week we're looking at the Reliance Growth Fund. Avan is going to give us a quick introduction. Avan.
Thanks, Faye. Well, launched in October 1995, the Reliance Growth Fund was one of the top performers in its category until 2007. And it hasn't managed to impress its investors since the slowdown of 2008. While the fund managed to contain its losses in 2008 by holding a large portion of its assets in cash, it was caught on the wrong foot when the market turned around and failed to meet its benchmark for returns that year. In the 3 years that followed, its mediocre performance caused the fund to slip into the bottom quartile of its category. The fund's assets under management have dropped from 5,500 crores in 2012 to 4,400 crores today. In this calendar year, though, the fund has shown a smart recovery. It managed to beat the category average in the 3-month, 6-month and 1-year returns. Let's do some math to give you a better picture. If you invested 1,000 rupees in this fund when it launched, which is 19 years ago, you would have 53,562 rupees today. So should you remain invested in this fund? Our experts are here to give you the answer. But should this turnaround mean it deserves to be considered by investors? Let's find out.
All right, Avan, thank you for that information. There is the Reliance Growth Fund. Now, over the last 1 calendar year, from January onwards, it has really improved its performance. But if we rate it like we always do over the long term, are you impressed at all?
Yes, the very long term, this is a very impressive fund. On key occasion in recent years, it has been extremely disappointing. Last 3-4 months, the kind of momentum it has gained looks like, this fund has changed its character in terms that this fund does very well in good times and really struggles in bad times. So this is how I would like to define this fund now. So it is less consistent, and but even now I would say that 10-year return or 15-year return, if you look at the SIP return, this has been one of the best performing fund.
All right, Narendra, the last time we rated this fund on the show, you gave it 3 stars. Where would you place it this time?
Given its inconsistency, I'll still give it a 3-star.
All right, 3 stars for the Reliance Growth Fund on Investors Guide. If you have questions about that fund in particular, or you're holding that fund in your portfolio, you can get in touch with us, and you'll find a copy of this review on our Facebook page if you want to listen to it again. Let's move on to our hold or sell segment. Well, Krish Kaushik has written in, Narendra, young man, 27 years old. It's always a pleasure to hear from young people on this show. He has a monthly take-home of 91,000 rupees. Now, here's where the email becomes a little disappointing. He's made lump sum investments in a few mutual funds, and he wants to know if that was the right thing to do. Now, interestingly, Krish, you first made the investments and then you got in touch with us. So now we're going to have to worry about how to pull that money out if you have to. Secondly, he wants to increase his investments through SIPs, and he wants to know which funds to invest in. Let's first look at the lump sum investments, Narendra. He has the Birla Sun Life Dividend Yield Plus, and he's invested 36,000 rupees as a lump sum in this investment. Would you like him to continue this investment, considering he's 27, he's unmarried, he's single, he has a long-term horizon? Is a Dividend Yield Plus fund the best one for him?
It's not a best fund for him, but it's a matter of what kind of portfolio he has. If he has 2 other funds, if 2/3 of his money is getting into growth funds of any kind, whether it be large or mid cap or, of any kind, then I would say that dividend yield fund fits into a portfolio. It should be a quarter to about 1/3 of one's portfolio. It's a conservative strategy. It does very well when the markets struggle. When markets turn around, these funds also make these funds turn around faster. And then these kind of funds provide great stability to a portfolio. So yes, if it is a part of his portfolio, he should hold it.
Well, it certainly is a part of his portfolio because 68,000 rupees of his portfolio, and that's a massive chunk, is in the HDFC group. So there's HDFC Equity, HDFC Top 200 and HDFC Balanced in that fund, which technically will all perform the same way. So he hasn't really diversified. So now looking at his portfolio, 3 HDFC ones, 1 dividend yield fund, Narendra, all lump sum investments. What would you like him to do at this point?
No, I would like him to drop the HDFC Top 200 and HDFC Balanced, and given that he's young and all his investments can be held for a very long period, HDFC Equity is just the best choice of the 3.
Here's the thing, Narendra, he has 25,000 rupees that he can spare every month that he wants to now invest as an SIP. Given the fact that he has these lump sum investments, he's given us a list of choices that we can choose from. There's the HDFC Top 200, Balanced, iPru Dynamic, iPru Focus Blue Chip, SBI Magnum Mid Cap and Birla Sun Life Mid Cap. Now, as we stand, a third of his money is in the Dividend Yield Plus, 2/3 is in HDFC Equity. Would you like him to just continue investing in these 2 funds and maybe add 1 more and not include 6 more funds in his portfolio?
Yeah, I think so. And I think he'll be much better off. One is that to keep it simple, he will be much better off, replicating our aggressive growth portfolio, given his age. Or even to keep it simpler, I would say that, if he adds 2 more funds of his choice, ICICI Pru Dynamic and maybe, SBI Emerging Business. And SBI Emerging Business can add, little zing to his portfolio. But generally, I suggest that you have fund which requires very low maintenance. You don't have to bother about them every now and then.
All right, so on your screen right now are the 3 funds that you need for your portfolio at this point that Narendra recommends. If you have any more questions, feel free to get back in touch with us. Let's take one more question before we go into break. Suresh Khurana has written in, Narendra, he will retire shortly after 36 years of service in the central government. Congratulations on your retirement, Mr. Khurana. He tells us he'll receive a lump sum of 60 lakh rupees when he retires. Now, this is the interesting thing, Narendra. He tells us he'll get a monthly pension. He has some income coming from other sources of investments. He has his own home. So between all of these things, his monthly expenses will be looked after. What he wants to do is invest this 60 lakh rupees. He's decided, of course, that 10 lakh rupees he wants to keep liquid. The rest of the money he wants to put aside long term to beat inflation. He already has 12 lakh rupees in HDFC Prudence, which is a balanced fund, and he falls into the 20% tax bracket. What should he do with this money? Let's first talk about the 10 lakh rupees that he wants to keep liquid, Narendra. So obviously, we're not talking about the senior citizen savings scheme because he's not generating an income. We're a little worried right now about debt funds because he's not going to be able to break it and take the money out without having to pay a lot of tax. Where would you like him to keep that liquid money?
No, one is that, he'll be liable for paying those taxes anyway, because look at his options. He needs liquidity with his emergency fund, which is 10 lakh rupee, and that he must have. He should make sure that he has this money lying in a manner which is accessible anytime, or maybe, at 24-hour notice or 48-hour notice. So from that standpoint, I would like him to, split this money in 2 parts. One is have, 2-3 lakh rupee deposit, which is accessible anytime. And maybe another 5-7 lakh rupees getting into a short-term bond fund. And, a lot of anxiety is built around the taxation of debt fund. But I think, when you compare it in terms of available options, it's not a bad deal. So from that standpoint, I don't think it is a disadvantage. Yes, it is not as attractive as it used to be before. So this will be my suggestion. Make a 2-3 lakh rupee, or, just think aloud about your possible emergency and make that, deposit. Remaining money into a short-term income fund. And your 50 lakh rupee can well replicate our stable growth portfolio. And that is a good part. The good part is that, that stable growth portfolio will have about 30-35% into fixed income. It will be treated as, all the investment held for over 1 year will be treated as capital gains, including the fixed income component of the balanced fund. And so all the gains from this investment will be entirely tax-free.
All right, so here's the advice that we're giving to you, Mr. Khurana. The amount that you want is absolutely liquid. Put it in a fixed deposit that you can break at any point of time. The rest of your liquid amount, put it in a short-term debt fund. On your screen right now, the recommendations of short-term funds that we have on this show. If you can keep that for at least 3 years, it means it becomes nearly tax-free, which is a good thing. You can break it if you need the money. The rest of it needs to go into our stable growth portfolio that's on your screen right now. right back if you need any more help. Narendra, thank you so much for spending time with us this week.
Thank you.
And answering all of our questions. Coming up after the break, we'll tell you if 53 is too late to buy a term cover, or can you still or should you still buy a term cover at that age? That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Gajendra Kotari is here to answer more of your questions on insurance. Gajendra, thank you for joining us. Our first question comes in from Ashok Joshi. He's 53 years old. He tells us most of his investments are on property. He now feels the need to buy a term cover in case something were to happen to him. He wants to know, is it the right time to buy a term cover? So at 53, Gajendra, it's going to be very expensive, first of all. But that doesn't mean he's not going to be able to. Would you recommend a couple of insurance policies that he can look at?
Yeah, Sophie, I think it's always better late than never for Mr. Ashok. At least now he realized that he should had a term cover. So ideally, if he would have taken earlier, it would have been better for him because the premium would have been lower. Now, if he wants to buy the term insurance, and I'm supposing he has dependents, I mean his children are dependent on him. So at least for the next 7-10 years, as long as he's working and if he's healthy, he can get term insurance from most of these companies. Now, obviously, the premium would be a little higher because of his age factor. For an online term insurance, I think at his age, he would be roughly paying around 40 to 45,000 for next 10 years or so. Still, I think it is a good option because that would give him peace of mind. In case something were to happen to him in the next 7 to 10 years, at least his family could get a reasonable sum, and that would help them survive for the next 10 years. And then, his children can start on their own. So I think he can go for any of these online term insurances. That should be good enough for him.
Abhishek has written in, he has 2 ULIP policies from Aviva with a term of 62 years and 15 years respectively. Now he tells us his primary objective of investing in these policies was for the long term. Now he finds the fund values in these schemes are the same amount as he had invested in them, and he's very disappointed. Should he cut his losses? Gajendra, what would you recommend he does?
Sophia, again, this is a clear case of mis-selling which was rampant during that time. And Abhishek also was a case in that. So I think the option with him now is that I think he can surrender these policies because the charges he's paying in these 2 policies are way too high. Whatever money, I mean, if he withdraws even now, there will be a lot of surrender charges and he'll be losing quite a sum. So what I can suggest is that 2 options with him. A, he stops paying the premium and let the amount being there, and he can withdraw after some time when the NAV again rises. Or if he can withdraw right now and again put in a good mutual fund where the charges are very low and that is where you can see returns, I think he should be fine. The choice of his funds when he invested that point of time were good. At least the money was in balance funds and a growth fund. So at least those options gave him a better value today, compared to debt funds. But now if he put into a mutual fund, I think his returns will be far, far higher from here on.
Last question from Ravi on the show. He tells us both of his parents are retired bankers with a health cover from New India Assurance with a sum assured of 3 lakh rupees and a monthly premium of 13,000. Now, he tells us he recently came across a family floater plan from PNB Oriental Royal Mediclaim, and he wants to know if the policy offers him a sum assured of 3 lakh rupees and a premium of 4,500 rupees a year. Does it make sense to shift to that policy? Gajendra, for a senior citizen who already has a running policy, and this is the big question, does it make sense for them to shift out of those policies at this point, because there'll be a considerable waiting period on diseases that they already have?
I think I would not advise Ravi to switch this from the New India Insurance to the PNB Insurance for 2 reasons. A, his father's New India Insurance is an active policy right now. It's a continuing policy, and it's been there for some time. So at least this would really help him when he requires to file for the claim. Secondly, the other policy which he mentioned is actually a group policy, and there are some disadvantages in a group policy. That is why you're getting at a lot cheaper premium. Couple of I would like to point out that because as long as your bank account is with them and you have to do a certain amount of transactions to become an active customer, so you have to read those fine prints that in what circumstances the policy will pay and what not. That is there. And secondly, this is a tie-up between the bank and the insurance company. What if someday the bank stops this arrangement? So then you're left in the lurch, you don't have any option to fall back upon. So what I would rather recommend is that continue with your existing policy. If you want to go for this policy as a standby policy or as an enhancement, then it can be a good idea. But to stop your existing policy and go for this policy as a pure, it can be a very risky affair. So I would not advise you to discontinue that and start this one. You can have both together, but don't discontinue the older policy.
All right, that's a wrap on Investor's Guide for this week. Thanks so much for watching. Now remember, we are going to do a special on insurance policies. We'll bring in members of the life insurance industry and we'll have them answer your questions. So if you have a policy and you're having trouble with that policy, feel free to write to us. You can also reach me on my Twitter page. Thank you so much for watching.